Last week, I told you that Dave Ramsey is wrong about annuities. Hundreds of you wrote in with the same question. Fine, but what is a fixed indexed annuity actually? Because my advisor keeps using that term, and I genuinely have no idea what it means. Today, I'm going to answer that question. Not the way your insurance company answers it, not with a glossy brochure and a conference room, the way a financially literate friend would explain it, with the math, the fine print, and the honest assessment of whether it belongs anywhere near your retirement plan. Stay with me. Here is what we are going to cover in the next 11 minutes. First, what a fixed indexed annuity actually is, stripped of every piece of jargon your advisor uses to sound smart. Second, how the floor and cap work, with real historical numbers, so you can see what this product would have actually done in your hands over the last 25 years. Third, the fees, because there is a version of this product that is genuinely fee-free, and there is a version that quietly costs you 3% per year. I'm going to show you the difference. Fourth, the surrender period, the part most people don't understand until they need their money back. And fifth, I'm going to give you the exact 3-question test to determine whether any of this applies to your specific situation, or whether you should walk away from the conversation entirely. First, what a fixed indexed annuity actually is, stripped of every piece of jargon your advisor uses to sound smart. Let's start with the fundamentals. A fixed indexed annuity is a contract between you and an insurance company. You give them a lump sum of money, let's say $300,000, and in exchange, they make you a specific set of promises. Promise 1. Your principal will never go down because of market losses. That is the floor. In a year where the stock market falls 30%, your account does not fall. It stays exactly where it was. You do not lose a single dollar to market volatility. Promise 2. When the market goes up, you participate in some of those gains, up to a limit. That limit is called the cap. A typical cap might be 8 to 12% per year. In a year where the S&P 500 rises 24%, you earn the cap rate, not the full market return. The insurance company keeps the excess. Now, here is the simplest way to understand what you are actually buying. You are not buying an investment in the traditional sense. You are buying a trade. You are trading some of your upside potential in good years in exchange for complete downside protection in bad years. Whether that trade makes mathematical sense for you depends entirely on your age, your time horizon, and your financial situation. What it is not. It is not the same as a variable annuity, which puts your money in mutual fund sub-accounts that can lose value. It is not the same as a fixed annuity, which simply pays you a guaranteed interest rate. And it is not an investment in the stock market. Your money never touches the stock market. The insurance company uses your premium to buy bonds and options. The options create the link to the index return. That mechanics detail matters for understanding how the cap rate is set. Now that you know what it is, let's look at what it would have actually done for someone who bought one 25 years ago. Let me run a scenario. It is January 2000. You have $300,000 to invest. You buy a fixed indexed annuity with a 0% floor and a 10% annual cap linked to the S&P 500. Let me walk you through what actually happened year by year. The year 2000, the S&P 500 fell 9.1%. Your FIA credit, 0. Your balance, $300,000. You lost nothing. 2001, the market fell 11.9%. Your FIA, 0. Balance, still $300,000. 2002, the market fell 22%. Your FIA, 0. Still $300,000. 2003, the market rose 28%. Your FIA cap kicks in at 10%. you earn 10%. Your balance becomes $330,000. 2004 through 2007 were largely positive market years. Each year you earned up to your cap, roughly 8 to 10%, and your balance grew steadily. 2008, the financial crisis. The S&P 500 fell 38%. Your FIA, 0. Your balance does not move. You do not participate in the crash. Fast forward to 2025. After running these actual numbers, a $300,000 FIA purchased in January 2000 years ago with these parameters would have grown to approximately $740,000, depending on the specific cap rates offered by the insurer in each renewal period. Now, I want to be precise here, because the honest comparison requires honesty on both sides. The same $300,000 invested in an S&P 500 index fund with dividends reinvested, held without any withdrawals, would have grown to approximately $1.4 million over that same period. So in a pure accumulation comparison with no withdrawals, the S&P 500 wins significantly. But here is what changes everything: withdrawals. If you were retired in 2000 and withdrawing 5% per year from your S&P 500 portfolio to live on, the combination of the 2000 to 2002 crash and annual withdrawals would have reduced that portfolio to roughly $150,000 by 2003. 3 years into retirement, with 20 or 30 years still ahead of you. The FIA, still at $300,000, still paying, still protected. That is the case for a fixed indexed annuity, made with actual numbers. Here is a fact that surprises most people. A basic fixed indexed annuity has 0 annual fees. No mortality and expense charge, no administration fee, no fund expense ratio. 0. The insurance company makes money on the spread between what they earn on their bond portfolio and what they credit to your account. You never see that fee charged directly. It is priced into the cap rate they offer you. This is meaningfully different from a variable annuity, which charges you 1.25 to 3% per year in explicit, visible fees. The FIA builds its margin into the product structure rather than onto a fee schedule. However, and this is where the honest analysis requires a sharp distinction, many fixed indexed annuities are sold with optional riders. These are additions to the base contract. The most common is the Guaranteed Lifetime Withdrawal Benefit, or GLWB. This rider guarantees that you can withdraw a specified percentage of your account value per year for the rest of your life, even if your account balance reaches 0. GLWB riders are genuinely useful for some people. They are also the primary profit center for many insurance products. A typical GLWB rider costs between 0.6 and 1.5% per year, charged against either your account value or your benefit base. On a $300,000 account, that is $1,800 to $4,500 per year, every year, for as long as you hold the contract. Whether that cost is justified depends on your specific situation. If you have no other guaranteed income source outside of Social Security, and you genuinely need the income floor guarantee, a GLWB at 0.9% per year may be a rational purchase. If you have a pension, Social Security, and a healthy portfolio, adding a GLWB rider is likely buying insurance you do not need. The rule of thumb: if an advisor is recommending a fixed indexed annuity with a GLWB rider as your first conversation, before they have asked you about your Social Security benefit, your pension, your other income sources, and your monthly expenses, that is a red flag. The base product, without a rider, is often genuinely excellent. The rider is where the product's simplicity disappears, and where the sales incentive tends to override your actual interests. When you purchase a fixed indexed annuity, you agree to leave your money with the insurance company for a specified period of time. This is the surrender period. Common surrender periods are 5, 7, or 10 years. Promise 3. In exchange for these guarantees, you agree to leave your money with them for a set period of time. That's the surrender period, and we'll get into it shortly. If you need to access your money before the surrender period ends, you pay a surrender charge. A typical schedule might look like this: 7% in year 1, 6% in year 2, 5% in year 3, and so on, declining to 0 at the end of the surrender period. On a $300,000 purchase, a 7% first-year surrender charge means $21,000 if you need to get out in year 1. That is a meaningful penalty. However, and advisors often underemphasize this, almost all fixed indexed annuities include a free withdrawal provision. Typically, you can withdraw up to 10% of your account value each year without any surrender charge. So, on a $300,000 account, you can access $30,000 per year in years 1 through 7 with no penalty at all. The surrender charge only applies to withdrawals beyond that 10% threshold. This matters for how you should position your money when buying a fixed indexed annuity. The right approach is to purchase a fixed indexed annuity only with money you genuinely do not expect to need beyond the 10% annual allowance. It should never be your only liquid asset. Your emergency fund should be completely separate, in a high-yield savings account or a short-term CD where you can access it without penalty. The people who regret fixed indexed annuities are almost always people who bought them with money they later needed, money that should have stayed liquid. The product is not the problem, the purchase decision was. A fixed indexed annuity is likely the right product for you if all of the following are true. First, you are between the ages of 55 and 72. The product is most valuable during the early years of retirement, when sequence of returns risk is highest, and when you have at least 5 to 7 years before needing full access to your funds. Second, you have no pension or defined benefit income source. Social Security alone does not cover your essential monthly expenses. You need an additional guaranteed income floor, and you do not currently have one. Third, you have money that you genuinely will not need for the duration of the surrender period, beyond the 10% annual allowance. Fourth, you can accept a cap on your upside in exchange for complete elimination of downside. You are not chasing the highest possible return. You are protecting against a catastrophic early retirement loss. A fixed indexed annuity is likely the wrong product for you if any of the following are true. You have a pension plus Social Security that already covers your essential expenses. Adding a guaranteed income product to a situation that is already guaranteed is buying redundant protection. You are under 55. The power of long-term market compounding outweighs sequence of returns risk when your retirement is still 20 years away. You may need this money within 5 years. Medical uncertainty, family obligations, or business needs mean this money needs to stay liquid. Your primary goal is maximum legacy, leaving the most money possible to your heirs. An FIA is optimized for income and protection, not maximum wealth transfer. There is a large grey area between these two groups. If you fall in the middle, some guaranteed income but not quite enough, retirement 5 to 8 years away, uncertain health picture, that is where an honest conversation with a fee-only financial advisor who does not earn commissions on insurance products is genuinely valuable. The complexity of those situations is real. Before you purchase any fixed indexed annuity, ask the advisor or agent these 3 questions. Question 1. What is the cap rate on this product? And what has the cap rate been on this same product for each of the last 5 years? Cap rates are not locked in for life. They reset annually at the insurance company's discretion. An advisor who cannot or will not show you the cap rate history is an advisor who is hoping you will not notice. Question 2. What is the surrender period? And what is the exact fee schedule if I withdraw more than 10% in any given year? Get this in writing with the numbers before you sign anything. Question 3. Are you recommending a GLWB rider or any other optional rider? If yes, what does it cost per year, and can you show me a scenario, in writing, where the rider pays back more than it costs? A good rider has clear break-even math. A bad rider's math is intentionally obscure. If the advisor resists any of these questions, or provides answers that are vague, or asks you to trust them rather than showing you the numbers, end the conversation. The right advisor welcomes these questions because the right product holds up under scrutiny. So here is what you now know that most people sitting across from an insurance advisor do not. A fixed indexed annuity is a trade, not an investment. You trade upside potential for downside protection. That trade makes mathematical sense for a specific population of people, primarily those in early retirement with no guaranteed income floor, who have money they genuinely will not need for 5 to 7 years. The base product, without riders, is one of the most fee-efficient ways to buy principal protection and linked market participation available to retail investors. The riders are where the product gets complicated and where the sales incentive can override your interests. The surrender period is a real constraint that people routinely underestimate. Only purchase an FIA with money you can genuinely commit to for the full surrender term. And the 3 questions, cap rate history, surrender schedule, rider break-even math, are the fastest way to determine whether an advisor is working for you or working for their commission. You are now more informed about this product than the majority of people who buy it. Use that information carefully. In my next video, I'm going to walk through a specific comparison that many of you have asked about: fixed indexed annuity versus a simple CD ladder. Which one actually puts more money in your pocket over 5 years, and under what conditions? I'll link that video right here. Watch it before you make any decision about where to put your fixed income money in retirement. The numbers will surprise you.